Hello and good morning, and welcome to this morning dose of how to build your capital stack at your startup. I'm Upasana from TIE Delhi NCR. A very, very warm welcome to all of you who are up and about in the morning to learn about how is it that you should go about building the capital stack of your startup at a time such as this, where I think most of you as entrepreneurs are kind of looking into how to sort of extend your cash runway, how to sort of make the most out of the capital that you've raised, and therefore how to, of course, raise the next round, how to get working capital in place. Today we have with us Avishek Gupta. And in Avishek Gupta, while Abhishek is the managing director and CEO of Caspian Debt, which is really providing customized debts to mostly impact social enterprise startups. But the interesting part here is that Abhishek is also a technology person. He's an engineer. He's a person who's actually done a startup early on in his life. So today you have a person who's a founder, who's a tech person, as well as somebody who can guide you very well on your on financial and your working capital aspects. So I think this is going to be a wonderful session. And I think there's going to be a whole lot of learning that all of you may be excited about. Abhishek will take about 40 minutes for his presentation, after which we will take questions from all of you. I'd request all of you to kindly type your questions in the chat box so that we can take questions accordingly. And we will, of course, read out your names when we are picking up those questions. But yeah, first 40 minutes, he will take you through the presentation, and then we will pick up the questions. Thank you all, and over to Abhishek.
Thank you, Upasana, and good morning, everybody. It's a pleasure to see all of you join on this session, and I hope an 11 o'clock session is you're all going to be bright and fresh. So what I'm going to talk about is essentially how you can raise non-dilutive capital. Typically, when you talk about startups and fundraising, most of the conversation is around equity. But reality is that equity is only one type of capital. There are other forms of capital that are needed to grow your business viably. So I'm going to use a slide deck to guide my conversation today. And I'm going to cover a few of the topics that we promised that we would. So I'll just share my screen. Just give me a second. Right. So we're going to talk about, or I'm going to talk about how to build your startup with the right kind of capital stack. And there are a few questions that I'm going to try and answer. Broadly around what are the different types of non-dilutive capital that are available? What do the different types of non-dilutive capital providers look for? How to be ready for that kind of debt or non-dilutive capital, when to take debt or not to take debt or non-dilutive capital. In fact, I'll start off with that. The goal of this session is that by the end of the session, all startup founders, business owners will have the knowledge about how to build a more capital efficient company. And by enabling that, by sharing that knowledge or talking about it, my hope is that you will achieve the long-term goals of your company or your startup while retaining greater control over your business decisions. And at the same time, retaining greater financial benefits which result from the success of your company. So the benefits of building a capital efficient company is not just about retaining greater control over your business decisions, but it is also about retaining greater financial benefits. This session is for startup entrepreneurs who want to build a professionally managed business that seeks to raise external capital, whether it is equity or debt, to grow faster than their profits can enable. There are several businesses and a significant number of businesses in India that grow on their own without raising external capital. There is nothing wrong in that approach. It depends on the priorities and the risk appetite of the entrepreneur. But if you are a business that you want to run in a professionally managed fashion and you want to grow it faster than what your profits can enable, this session is for you. At the same time, this session is also about entrepreneurs who are not willing to trade control of the business decisions in return for significant access to capital. I'll explain this a little later, but depending on the nature of capital, whether it is equity or debt, the control over the business decisions and the future of the company changes depending on the nature of the capital. So I'll talk about or start with the first aspect, when to raise debt or when to raise equity. Before we talk about that, let's talk about the nature of debt and equity. Equity is long-term capital, and it doesn't generally come with a pre-agreed schedule of repayments. It doesn't mean that equity investors don't expect the money to be returned to them. In fact, equity investors are, at the end of the day, investors. They would invest money and then expect the money back in a certain time frame, but they don't give you a monthly repayment schedule or a quarterly repayment schedule like a typical lender. Equity is a share. Equity investors take share in your company. So there is a loss of ownership and control in the business, which you give in return for the capital that you raise from the equity investors. And it is generally agreed that equity is the most costly form of capital. But does that mean that you should not raise equity? Not really. You should, when your investments are in a type of a business where the timing of cash flows are not certain. These are typically in the earliest stages of the company, or in areas like new product development, and like I said, in the first cycle of revenue generation. So equity does serve its own purpose, but you have to find a way to make sure that it is not taken at times when you're better off taking capital from other sources which do not lead to a loss of ownership of the company. Now, that's what happens with debt or non-dilutive capital. But with debt, you are contractually required to repay the amount that you've taken under a fixed or a pre-agreed repayment schedule. There can be a lot of flexibilities built into it, but at the end of the day, there is a start date, there is an end date, and there is a frequency at which you need to pay. You don't lose control or ownership of your business if you pay the money on time, but you have to pay a fixed rate of interest. So the cost of a debt or a non-dilutive capital is typically known upfront. For equity, however, the cost is typically not known. The more successful you are, the cost is higher. If you are not as successful, technically the cost is lesser of equity. So if you are looking to build a successful big business, you may be better off using a blend of equity and debt, because at the end of the day, the cost of debt is capped. Now, where should you use debt? Debt should be used only in cases where cash flows are more predictable. Meaning, you purchase stock to sell and you know that you are going to be able to sell in the next 15 days, 1 month, whatever the time. Or you need to buy equipment that will enable you to increase your production dramatically and increase your cash flows. You should not use debt for research and development or product development. You should not use debt for your first cycle of revenue generation where you don't know by when you'll receive or collect your revenues. for that, equity is much better suited. Just to remind everybody, if you have questions, please feel free to drop your questions on the chat. I will try and respond to all the questions at the end of the session. Now, I told you about, considering taking debt for specific use cases like capital investments that will lead to immediate increase in cash flows, or for purchase of stock that is going to lead to increase in your sales. But reality is that for startups, traditional sources typically do not offer loans, especially if your loan requirement is more than 1 crore. For about 15, 20 lakhs, or sometimes even up to 50 lakhs, you can get debt support from the traditional banks. But beyond a point, the banks do not support you, or the traditional non-bank finance companies also do not support you for a larger loan. One of the other issues is that if you do not have a mortgage collateral or an easily resaleable asset, getting a loan of more than 1 crore is near impossible. The other situation is that there are new types of capital sources that have been developed, like venture debt. But if you don't have a reputed VC, venture capital equity investor, now reputed in the eyes of the venture debt provider, if you don't have that kind of an equity investor, or if you are a bootstrap company, or you are basically building the company from your own capital, the entire equity is owned by you, it is very difficult to get debt, even from venture debt providers. And lastly, if you're not profitable, a lot of startups that raise equity capital, venture capital, often focus on growth over profitability, even if their business models are clear. But if you're not profitable, typically a traditional lender will not give you a loan. So what generally happens is, because it is difficult to evaluate businesses, some lenders evaluate the asset, meaning, if there is some equipment, some mortgage that is available. In some cases, the lender or the debt provider will evaluate your counterparty. So for example, if you're a B2B company with a buyer who is large and well-rated, they will evaluate them. And in some cases, like venture debt, the debt provider will evaluate your investors. Unfortunately, it seems that there are very few people who actually evaluate your business and lend based only on that. All the types of capital providers that I talked about do evaluate a business to different degrees, but by and large, their decision-making factors are dependent on aspects other than your business. Now, the reality is that you may not have a mortgage collateral, you may not have a reputed VC investor, you may not have profitability. But what you have is your business, and there are lenders who are now taking decisions on lending based on the core business or the data that you share with them. Now, what do these kind of lenders look for? We're talking about non-traditional lenders who look at not the proxy of a mortgage collateral, not at the proxy of 3-year profitability. So what do they look for? Broadly, they look at 4 areas: governance and management, business and operations risk, processes and systems, and financial performance. In fact, for a typical lender, traditional lender, these are the same groups of categories where they do their evaluations. But in a traditional lender, the financial performance comes right on top. Almost 80% of the evaluation is based on that. And remaining 20% is covered by governance and management, quality, business, operations, risks, processes, and systems. But a lot of the new age non-dilutive capital providers, their evaluation methodology is typically flipped. For example, for Caspian Debt, 80% of the weightage of credit evaluation goes to the first three factors, and financial performance takes care of about 20% of the factors. So what are these? What are the aspects? Let's go about it in a little bit more detail. So like I said, you may not have mortgage collateral, you may not have 3-year profitability, but you built a solid business. You should have data on the business. And that is what, if you can credibly share, improves your chances of getting access to debt. So the first thing is about data transparency and verifiable track record. As a company, you should be well organized and well set up to have the ability to share MIS reports going back at least 12 months, assuming you've been in existence for 12 months. It should cover at least the details of revenue, expenses, and receivables. Typically, for a loan of above ₹1 crore, lenders will expect at least 1 year of audited financials. Lenders will expect GST statements and bank statements. Now, if you have difficulty or if you have reluctance in sharing these statements, it is going to be difficult for lenders who are interested in evaluating you based on your performance to consider you for any loan or any form of non-dilutive capital. Because what do they lend you against? Because you don't have mortgage collateral or 3-year profitability. So what do they lend you against? One more aspect that is very critical is that for any lender to make a loan, they have to do a credit evaluation. And they generally shy away from doing credit evaluation if the process, the availability of data is too difficult. They don't want to spend a lot of time evaluating the credit, because at the end of the day, the loan amount that is typically expected by a startup is not in hundreds of crores. It's a couple of crores, maybe 1 crore, maybe 10 crores. But that is too small for a typical lender to spend months together evaluating. They don't want to do that. So providing the track record or MIS transparently and quickly improves the ability of the lender to take a positive decision. There are a few other areas like revenue certainty. Like I said, debt should be taken only when the revenue is more or less certain. If you take debt in a situation when your revenue certainty is not there, forget about the lender taking a decision to lend to you. You will be causing harm to you if you take debt at that point of time. The other aspects, if you're a bootstrap company, you should have operating positive cash flows. If you are not bootstrapped and you're venture capital backed, your equity investors should have given you enough cash to pay for the repayments, or should have committed to pay for the repayments if and when they come up. Because if you're a venture-backed company, more often than not, you may not be generating positive operating cash flows. Typically, lenders would expect, the alternate lenders would expect a minimum of 12 months of cash reserves to fund the business operations, including the repayments. Anything shorter than that is generally not acceptable by lenders because it takes that much time to raise the next round of equity. The last aspect is, there are a few other things, but the last aspect on this slide is that aspects like gross margins, buyer's profile, relationship or continuity relationship with suppliers, all of this is important. So are you a positive gross margin business or a negative gross margin business? Typically, lenders will not fund negative gross margin businesses. Is the profile of your buyer dependable? Will they continue to exist? Will there be a continued demand? All of these things are considered. One of the big areas that a lot of startups do a significant amount of work on is technology. You build new hardware or new software that will improve the lives of people that you are selling to, is your assumption. So the technology is actually a good indicator of whether there is business viability in the long term. But lenders essentially are not the ones who will take a bet on the technology. It is the equity investors. Lenders would like to see, of course, they will recognize that technology is great, but is it generating cash flows from the next month? If it is not, then don't use debt to finance the cost of building the technology. Use equity to do that. There are a bunch of other things like relevant experience of the promoters. An equity investor may be okay to come in and make an investment into a promoter who's just started off a business after college or started off a business in an area that they are unfamiliar with. But a lender would typically want some expertise. Even of running the same company, if you run that for 3 or 5 years, is actually positive. Credit bureau history or credit track record, the personal credit track record of the promoters, the directors, and the company, if the company has taken any loans. This gives an indication of the seriousness with which the promoters run the business and are serious about repaying loans. Lenders look at the collections rigor. So for example, if you sell on credit, do you have systems in place that are tracking the receivables aging? Are you able to collect your receivables? Because a lot of startups tend to grow their revenue, so they'll book the revenues, but they forget about collecting. Do you have a collections rigor in place? What are the quality of internal controls? Now, these are the boring things, statutory filings. These are the boring things. Everybody, when they talk about startups, they talk about, changing the world, disrupting the world, and so on. But really, all large companies do not survive on air. They survive on good quality internal controls. They survive on good quality compliance. And if you are not compliant with the laws of the land, or if you do not have adequate internal controls, it is less of your problem that a lender is not lending to you. The reality is, if you don't have good quality internal controls, and if you don't have good quality compliances, the chances of you growing is actually limited as a company. So have you paid your taxes on time? Have you always paid the EPF or the PF dues of your employees on time? Things like these are going to be asked. Now, what are the different types of loans other than, of course, the typical asset-based loans that a traditional lender provides? Within that, if you combine both the traditional and the non-traditional lenders, there are a variety of bases on which loans are provided. So one is, of course, the asset-based loans. And I'm talking about all types of loans that are not dependent on mortgages that could be available to you. So for example, if you need equipments to run your business, you could potentially get an equipment loan from one of the non-bank finance companies or banks. But the equipment has to be well recognized and understood. It should have an resaleable value. A lot of lenders like liquid stock. When I say liquid stock, I mean easily resaleable stock that you'll buy and sell within, say, 15 days. Non-perishables, even better. And of course, some lenders do lend based on mortgage collateral. A lot of the times we've seen startup promoters having their own personal property, which they give as a mortgage for the loan that they take for the company. This typically comes at a lower rate, but it is possible only when you have mortgage properties for your own. But banks do lend in such situations. Supply chain or transaction-based lending are also options that you can take if you have a B2B business, meaning you are selling to a larger corporate who has a good credit standing. You could take bill discounting or supplier finance in those kind of cases. There are quite a few non-bank finance companies and sometimes even banks who provide you that financing. Venture debt is a new kind of debt that has come into play in the last 7 or 10 years. This is typically provided to companies that are backed by reputed institutional venture capital equity investors. And the venture debt provider essentially evaluates the commitment and ability of the equity investors to put in more capital if the company needs more equity capital. The most recent phenomenon is, of course, the revenue-based financing. This is based on a certain level of, predictability around your revenues. Generally, out of all these types of loans, revenue-based financing and venture debt tend to be costlier, but they also have a lot of flexibility built in to the product structures. A venture debt product, for example, may come at a low rate of interest initially, but you have to give up a little bit of a share of your company, ownership of the company, in the form of equity shares, to enable the venture debt provider to make the right kind of return for having taken the risk. Revenue-based financing, again, is typically not a fixed rate of interest, but it is dependent on the revenues that you make. If you make more revenues, you pay back more. So it becomes costlier when you pay back more, but it is not a fixed rate of interest. Even though in India, I think most examples of revenue-based financing require a minimum basic repayment every month, but typically it is on a lower side. And when you combine that with the increase in revenue, it tends to be costlier than typical loans that are asset-based or supply chain transaction, supply chain or transaction-based lending. Now, where are the sources? We talked about the types of loans. Now, there are these different types of sources. Now, there are these fintech firms, loans up to 10 lakhs, sometimes even 20 lakhs are provided by some of the fintech firms that provide financing for e-commerce sales. If you're selling on an e-commerce platform, you can get these kind of loans even if you're like 6 months in existence. There are small business term loans that are available from NBFCs or fintechs, but you have to be profitable. And these are loans up to 30 lakhs, sometimes up to 50 lakhs. And these are unsecured loans. You have to be profitable. I talked about bill discounting. You can get it from banks. There are some NBFCs also that are doing this. You can get loan against property from NBFCs of up to 50 to 60% of the value of the property as a mortgage. Lastly, CGTMSE. This is a scheme of the government under which the banks, typically public sector banks, would give you a loan of up to, will typically give you a revolving facility or a credit limit, revolving credit limit up to 2 crores. Recently, the government has increased or proposed to increase the limit to 5 crores, but I don't think it's been operationalized. So these are all the different sources of debt that you can get access to from different sources. What I would end is by saying that the purpose of a business is to solve a customer's problem and to help you realize your dreams of solving that problem as an entrepreneur. The purpose of building a business is not to raise funds. In most cases, raising funds from equity or debt from external sources is actually incidental. It can be done within, you can build a business that is heavily profitable that doesn't need to raise external capital. There are several examples of that sort. So that is a good model to follow. it is an equally good model to follow when you want to raise capital from external sources, but don't build a business thinking that raising capital is the primary goal. The primary goal always has to be building a strong business. The second aspect is, while money is fungible, whether it is equity, debt, or grant, everything has a specific use case. So link the use case or the type of use of the money to the type of funding that you get. Like I said, use equity for long-term uncertain cash flow situations, use debt for more certain near-term cash flow situations. What you also have to recognize is each and every investor or lender or grant funder is not your fundraising target. So you will have to do a little bit of a research to figure out who is the right kind of capital provider for you. And the right kind of capital provider for the same enterprise can change over the life of the enterprise. You may start off initially with a small loan from an NBFC, then you may raise some external equity capital, raise venture debt, or you may come to people like us who can do venture debt, normal term loans, revolving facilities. And then you may go to a bank and then come back again to a venture debt provider or somebody like us or a corporate lending institution. But what you have to realize is that all lenders are not suitable for you at every stage of your life of the company. Similarly, all equity investors are not suitable for every stage. Lastly, do a lot of research to figure out who's a non-dilutive capital provider who can be a partner beyond just the money. It is easier said, very difficult to do. Some businesses have it in their core operating model to try and be of support to the companies that they finance. Some businesses just don't do that. It's not there in the business model. And what kind of support can you expect? The kind of support where, for example, you can get connects to equity investors if you need, you can get connects to other larger lenders if you need, you can get support in the form of advice on how can you build better internal controls, you can get support on references for hiring and all these kind of things. Typically, this is expected of equity investors, but a lot of the new age debt providers are also doing that. So that's all from my side. And before I end, as Caspian Debt, based on our experience of having financed more than 230 startups over the last 10 years, providing customized debt to all these professionally managed companies operating across sectors like clean technologies, food and agri, education, healthcare, sustainability, and financial services, we have figured out a few things that help startup entrepreneurs to make themselves ready for debt. So we've created a handbook on decoding debt for startups and social enterprises that we can share with you for free if you're interested. So for all those who've joined this session, if you are interested in looking at this book, handbook, please feel free to request a copy at info@caspian.in. We will send back a copy of this handbook to you, which should be like a quick ready reckoner for you to get yourself debt ready very quickly. So that's all from my side for now. Happy to answer your questions. I think some of you have left questions on the chat. So I will go through the questions and try to answer those questions. I think there's a question about a company with offshore office with India back office and also India customer market. Should you get funding from offshore or India? So the response to the question is that if you have an office in India and if you have customers in India with a P&L and balance sheet that you create for India, you should be able to get funding from India. Typically, what happens is if you do have a presence offshore in the developed markets like US and Europe, if you are able to borrow in those markets, generally the cost of funding should be lower. But in a lot of situations, when you have domestic and offshore operations, it may make sense for you to borrow in the domestic markets, especially if you have customers in the domestic markets. We've seen companies based in, with holding companies in Singapore, with holding companies in the US and some European countries, raising debt in India for their India operations specifically. Because typically it is much easier to raise debt in the domestic market for the size of startups that we, debt requirements that startups generally have. But if you don't have, if it's just a back office and you don't have much customers, or if you don't have customers in India, I think it's going to be difficult sell to get a loan from an Indian lending institution. Question from Devang. We are a bootstrap company having good net profit. Is it good strategy to issue bonus shares in such situation? I'm actually not the right person to answer this question. I think you should ask, an equity investor to, talk about this. I can only talk about debt. Another question from an anonymous attendee is that I heard about a 10 crore collateral-free loan scheme launched by government last year. Do you have details about that? Yes, it is. It has been launched, different venture debt funds can get access to it. Even beyond the government scheme, there are lenders like us. So we provide loans of anywhere between 50 lakhs to 15 crores, entirely collateral free or mortgage free. So there are lenders like us who are already providing collateral free debt up to 10 crores. I think this scheme that the government has brought up is more targeted towards banks who typically do not provide a 10 crore collateral free loan. I think the government has come up with this scheme to encourage the banks to make these loans. So you will have, and I have been hearing a few cases of banks starting to make these kind of loans. So you should talk to your banking partner and find out if they are, making these loans. But at the end of the day, the typical business model of banks is such that they would not want to make a lot of these loans. You would have to depend on venture debt funds or, corporate lending NBFCs that do these kind of loans as a part of their bread and butter business. So like I said, we've funded more than 230 or 240 companies. It's without any kind of mortgage collateral. Another question from an anonymous attendee is that if a co-founder is stepping in with certain investment, what type of capital is that? An equity based? Yes. I mean, it depends on, the expectations. So for example, we have seen cases where co-founders actually put in capital into the company, but they put it in as debt, meaning that they expect to get paid back before their equity capital is paid back. And they expect to get paid back on the loan with a certain rate of interest on a periodic basis. So unlike an equity investment, when they're not expecting monthly or quarterly, rate of interest being paid, in case of debt that the co-founders of the company put into the business, they typically expect some kind of quarterly interest rate. It may be very low, but some kind of interest rate to be paid by them. I think in a lot of situations, co-founders or promoters of companies put in debt into the company just to be sure that the debt can be taken out as soon as the business no longer needs that debt from them, and to reduce the amount of capital they invest into the business. But typically, if you put in debt as promoters and you expect some more debt from a lender, especially when you're borrowing for the first time and situations like that, the first time or the second time lender would typically consider the debt provided into the company by the promoters as quasi equity. So they would expect that that amount, the principal amount, not be repaid during the tenure of the loan. But they are typically okay with some kind of rate of interest being paid on that loan, which is not what typically happens with an equity. On your second question, again, I'm not the best person to answer this on the correct percentage of investment and stake. Typically, on a, to keep things simple, it should be 50-50 if there are two co-founders. What is the usual IRR for revenue-based debt financing? From what I have seen, based on calculations on some of the portfolio companies that we've financed, and they have taken revenue-based financing, it is in a range of anywhere between 20 to 30%. The faster you grow, better you grow, the IRR typically goes up, but you don't have problem paying that because it is something you're paying a higher price when you are growing faster. We typically don't do at Caspian Debt, revenue-based financing is one of the products, but most of our products is, simple, straightforward term loans or venture debt. Typically, the rate of interest for those kind of the loans that we provide varies between, again, depending on the size of the company. We provide debt to companies between revenues of 3 crores to 300 crores. So the rate of interest could be anywhere between 14.5% to 18%. What kind of operational support? So this is a question from Bharat. What kind of operational support can be expected from debt lenders? It is very low, but typically the kind of thing that happens often in some kinds of lenders is that you can get a lot of lenders have the ability to connect you with equity investors or other lenders. There are often, for example, entities like us, we organize an annual portfolio company CXO meet where there is a lot of intercompany business support that can be identified. There are training programs that we organize for the CXOs and head of departments of companies on different areas like financial control or HR policies or even climate footprint measurement. But these are trainings. These are not ongoing operational support. Rahul's question again is there flexibility on tenor, say instead of 12 months, extendable up to 24 months? Yes, I mean, it depends on the lending institution. For us, we do anything between 6 months to 3 years, sometimes 24, sometimes 5 years as well. But generally it is up to 3 years. Typically, I think what you're asking for is, can the tenor change on the fly? Given the way the regulations in India work, it is difficult for non-bank finance companies and banks to do that. There has to be a specified end date. But typically what happens is that you can take a 24-month loan with the flexibility to prepay it sooner if you want to, without any prepayment penalty. There are instances when lenders do give you those kind of flexibilities. There's a question from Prakap. I'm hoping I'm pronouncing the name correctly. Can you elaborate on the typical interest rate for different scenarios? What should be the range for a 50 lakh loan for 24 months? Again, it depends. What I've seen from a typical fintech lending institution, 50 lakh loan for 24 months could be anywhere between 16 to 20%. depends on several things like your current cash flows, profitability, your vintage of how long you've been there, and so on. If you're able to get a loan from a bank, however, where there is a mortgage backing available, the rates could be much lower, like 12 to 13%, or maybe 15%. If you're a priority sector entity, which is, Reserve Bank of India has this categorization called priority sector lending, where if they encourage banks to lend to that segment. So if you are an agri company or a clean energy company meeting specific criteria of the banks, you could get loans at 11, 12% as well. Another question from Bharat, can you explain more about funding for tech if tech isn't making revenue immediately? So first of all, if the tech is not making revenue immediately, the best form of financing to raise is equity. At the same time, if you are a company that is already built some tech and you are already generating revenues on that, but you want to build new tech, and for that you need to spend, you could still get a loan if the revenue generated from your existing tech or solution is enough to repay the loan. So while you are investing the money in the development of the new platform, if you have a developed platform already that is already generating revenues, a debt can be a good source. But you can't expect the debt, or you should not use debt to build a completely new platform when your company doesn't have revenues from any other source. Vishal's question is, I'm into B2B e-commerce analytics. Over 4 years, bootstrap profitable, but cash flow seems to be a challenge because of continuous expansion. I need to raise funds. What would be your advice? If you're a B2B company with good quality counterparties, so two things. From what I understand, your cash flows is a challenge because of continuous expansion. One is you're growing fast, and your working capital requirements is expanding because there is a period of a month or probably 3 months after which your B2B customers are paying. In that kind of a case, if you have a track record of payments received from your customers, you should most certainly look at raising debt. We've seen this multiple times where B2B customers, or whether it is analytics or even product supplier companies, if you have track record of getting paid on time or within a predictable time range from a set of dependable buyers or customers, you should be able to get debt. Anonymous attendee's comment is, I feel lending standards seem more strict in India. The property-backed loan seems concerning. I didn't know such loans in offshore places. When will India move away from property-backed loans? I think property-backed loans are quite common. I mean, even in the offshore markets. I mean, there's this whole real estate-backed, property-backed lending as an asset class on its own. But I agree with you that the Indian lending, traditional lending processes depend a lot on mortgaged property. And it is concerning. But the reality is that if you look at the Western markets, the availability of verifiable data and the legal safeguards available to lenders is much better. In India, legal safeguards are difficult. So that is why people fall back on mortgage property so that they can recover in case the loan is defaulted. If the availability of data or sharing of data improves with credit bureau data, GST data, bank statement data, and which is what has been happening over the past few years, the ability of the lenders to give a loan without mortgage collateral increases significantly. And I think we are going in the direction where lenders are starting to consider lending based not on mortgage collateral, but based on data. But the companies will have to be ready with the data. They have to have proper systems and processes to be able to share that data. If that data transparency is established, the mortgage-backed lending phenomenon will stop slowing down. Shankar has asked a question on approx range of interest for different debt products, especially for venture debt. Venture debt products typically come at an interest rate of anywhere between, I think, 14 to 16% of rate of interest. But there is an additional warrant or upside that is also required to be provided at the time of exit of the lender. And overall, generally, the cost in a successful situation ends up being anywhere between 20 to 30%, sometimes more, but I would say ballpark 22 to 25% is where the venture debt ends up costing. Vinod Sood is talking about a startup looking for debt, revenue financing. They have an ARR of 3 million USD. They have confirmed orders from well-known. Okay, so this is about, this is business for me. Yes, sure. I will leave the contact details. We can talk to them. What if a startup has predictable cash flows within a year of their operations? We have seen cases where, I don't fully understand the question on whether the company is already making cash flows or the company is not making cash flows but will make cash flows within a year. But the point is, if the company is already making cash flows, even within a year of operations, typically it will be able to raise debt, but a small amount, initially from the fintech NBFC lenders. But if you are and this would be loans of, say, I would say 15 lakhs, 20 lakhs at maximum. And there has to be verifiable data. So bank statements have to be there, GST statements have to be there, or you have to be a seller on a e-commerce platform. So some verifiable data, if you have, you should be able to raise debt within a year as well. But if you want to raise more, say more than 1 crore or something of that sort, more than 50 lakhs, typically at least 1 year of operations is necessary. In fact, raising debt sooner than that could be detrimental for the company. Revenue, Shankar's question is about revenue-based debt. How does this work? It's basically a form of debt where when you repay the loan, you pay a percentage of your revenues as a part of your repayment. So if your revenues, so instead of paying a rate of interest like 15%, 16% on the outstanding amount of loan taken, you pay 2% to 5% or sometimes slightly more on the revenues of your company. So you pay back your loan amount, the principal amount. So you've taken 100 rupees loan. If you are taking a normal loan, you will pay a percentage on the outstanding amount of that 100 rupees every month. In case of a revenue-based loan, you will pay back that 100 rupees over a period of time, but the interest, in a way, is going to be a percentage of your revenue, whether it is 1%, 2%, or 8%, or 10% is something that the revenue-based finance company will tell. The benefit of this is that you pay less if you don't grow as much. If you grow better, you pay more. How is venture debt? Anonymous attendees asking, sorry for asking a bit. There are no basic questions, so thank you for asking this question. How is venture debt different than revenue-based debt? The primary difference is that venture debt is typically a kind of debt where there is a small equity share taken by the lender, whereas revenue debt typically doesn't take an equity share. Or an equity kicker. The kicker or the increase in IRR comes from the growth in the company. For a startup company, for a need, SM is asking startup need for 10 to 15 lakh loan, which is the best way to raise debt. I think any fintech, NBFC, MSME lending institution should be able to give you a 10 to 15 lakh loan. I would recommend you to start off with that. And then as you grow, you raise debt from other sources. For example, we have a partnership with Indifi, which is a fintech lending institution. They specialize in making these kind of loans. So you can try their website. What if startup has predictable cash flows within a, okay, I think I answered this question. Okay, Vishal, I think is reconfirming. Yes, I think the answer is yes. Anonymous attendee is, I think is the same question. Okay. Anonymous attendee is asking, I haven't seen collateral for equity funding here. Yeah, so collateral is not, it's only, expected in case of some case of debt, mostly bank debt. Equity is an ownership in the company. See, the point is that equity investors invest in the business in return for becoming partners or shareholders in the business. A lender doesn't own the company or doesn't become a shareholder. So they look for other forms of ways in which they can safeguard themselves. An equity investor safeguards themselves by owning a part of the company, taking a board seat, controlling the decision making. A lender doesn't do all of that. They basically say that you have to pay me back on a particular way, but then in return for that, you have to pay me an interest. And depending on the risk appetite of the lender or the rate of interest charge, they might expect something like mortgage collateral or something of that sort. For equity-based debt, Akshat is asking, for equity-based debt, I'm basically giving away equity, and I also need to pay a percentage of interest on the debt. Yes, but it is not necessary for you to do that, right? Because there are lenders who lend to you without you having raised equity from external sources. So they may be better off. So for the point that I'm trying to make is that you should not raise equity because you want to raise debt. It doesn't work that way. You should raise equity only if your business is in a position that the cash flows are unpredictable. And once the cash flow gets to a predictable stage, you raise debt. So you should never raise equity to raise debt if that's what you were trying to say. But you are right in a way in what you're saying, that you need to give away equity if you raise equity, and also need to pay a percentage of the interest in the debt. In case of venture debt, both of these things happen, but you have to understand that the share of equity that they take is very small. It's probably between, it's less than 5% generally. So they don't actually own the company like a shareholder. They just take an equity share so that they can get some returns when the company does better in a future equity round. So I think those are all the questions. That's all from my side. Any of you who is interested in more details, please feel free to write to us at info@caspian.in, info@caspian.in. We will be happy to send out a handbook on decoding debt for startups and social enterprises to you. If you need any more information, or if you need any more details that I can be of help with, you can write to me at avishek@caspian.in. That's all from our side. Thank you.
Thank you so much, Avishek. I think that was very, very enlightening. And I think a lot of people actually even got their direct queries answered. That was wonderful. Folks, like Avishek mentioned, you can drop him a mail directly. In case you've missed that, you can reach out to us as well. Thank you for joining. We will be in touch for many, many more such things that we keep conducting. We are also now running a bunch of activities and events in the physical format. I'm sure you're getting intimation on that as well. Thank you, Avishek, for joining us. We'll be in touch. Thank you, everybody.
Thank you, TIE Delhi. Thank you.